everyone. It's time for another episode of Mayhem in the Markets, coming to you Sunday, January 15th, and brought to you by TraderAid, where we help investors and traders become more consistent in an ever-increasingly uncertain market environment by focusing on the trifecta: macro, fundamental, and technical analysis, both providing insights and education to help our members get a better grasp as to what's going on and why it matters. Our first chart, debt's up, savings down. The consumer is not looking so hot. We're seeing that consumer borrowing, particularly by credit cards, is surging as they struggle to keep up with rising costs. On the other hand, the savings rate has plummeted. Now, we can see this in a number of other areas. Large banks like Bank of America and JP Morgan are writing off more bad debt. They're taking larger loan loss provisions, and they're telling us that they expect more of that to come. We also see University of Michigan's Consumer Sentiment Survey coming in a little better than expected, but close to historic lows. A lot of this tells us that the consumer is not doing so well. Millions are late on rent, utility, and other payments, and this is showing a consumer that is struggling to pay for the bare essentials, the necessities in life. And that's not what you want to see in America, where 2/3 of consumers are already living paycheck to paycheck, and 2/3 of GDP is from consumption. Mortgage costs are the highest in decades after we've seen the cost of home ownership more than double, and home buyer sentiment, like consumer sentiment, at or near historic lows. This is another sign that the housing market is in trouble. And it's likely that these rates aren't going to soften meaningfully anytime soon. So the path of least resistance is for home prices to come down. And as they do, it's going to unlock more and more motivated sellers, adding to supply in a market that's already arguably oversupplied, as there's about 3 months worth of supply hanging out, wanting to be sold, as sellers continue to cut prices. Eventually, we'll see more and more of these sellers coming on the market. We have people who bought second, third, fourth homes to rent, to vacate to use for Airbnbs, and a lot of those plans aren't working out, and as budgets become tighter, people need to unlock that liquidity so they can pay for their house, their primary residence, for their bills, or make up for the potential of a lost job or other difficulties they may encounter in life. So seeing mortgage rates surge and the cost of a mortgage increasing meaningfully to a place we haven't seen in many decades is not an encouraging sign for the real estate market, which makes up 15 to 18% of the U.S. economy. It suggests to me that both home builders and REITs likely have some difficult times ahead, because think about it this way. If you're a home builder, what are you doing? You're adding to supply and hoping to sell at a premium. You're also borrowing. All these projects are financed, and a lot of this financing happens through revolving lines of credit, and those costs are going up. So what happens, and we're already seeing it in the home building sector, is that the price that they can sell their properties that are fully built are dropping. But worse than that, we're also seeing cancellations of new projects and backlog. New projects are down about 17%, backlog about 23%. And KB Home's earnings came in last week, and what did they tell us? That net orders were down 80% year over year. None of this is good, and the sector continues to levitate on what I can only assume is hopium, because there's not a lot of fundamental reasons to be bullish about the future of this sector in the near term. So I'm looking at this with a great deal of skepticism and saying, those economists that are saying home prices could fall 20, 30%, they're dead on, and they may even be conservative. Cooked to perfection, hand-seared Chinese bank books. It does seem to be the case. These Chinese banks, their valuations are trading at lows we haven't seen in well over a decade. But more concerning is that's investors saying, we don't believe you. We don't believe what you're telling us. And we're pretty concerned about what we're seeing. So we don't want to own your stock, even if it appears to be selling at 50% or more off of what it could be worth. ARK bleeds as the old economy leads, and this is something that really started to take off in 2021. We can see that parabolic move that ARK had. Of course, Cathie Wood is still telling us that we're headed for imminent deflationary destruction, and somehow, magically, that's good for innovation. Never before has intense deflation been great for innovation, by the way, because it would crash the price of those stocks. It would. Now, if we saw meaningful disinflation and we saw the beginning of a new credit cycle predicated on central banks meaningfully pivoting, cutting rates, engaging in QE again, maybe this stuff would have a brief bid. But I don't think it's going to have the kind of run it had from 2020 through 2021 anytime again in the near future, because a lot of these inflationary pressures have become structural in nature. So the idea that ARK is going to rebound violently and we're going back into this paradigm of disinflationary bubble stocks running to the moon, I just don't think that's going to be a case that we can count on. And in fact, if we look at prior bull markets, we can say that often is the case that prior leadership is not the next leadership. For example, during the dot-com boom and bust, tech led. Then the next bull market, it was real estate, finance, insurance. And then the bull market after the great financial crisis from 2012 on, at least, was led by tech. So at best, you get maybe an every other. But I think in the next bull market, it will be led by the old economy because these structural inflationary forces, particularly driven by constraints on the supply side, continue and grow. There's not enough being done to address the inelasticity of supply. So we're going to get into the next credit cycle, likely with higher prices and inflation to start earlier on. As demand begins to grow, there won't be enough supply to absorb it, which means a lot of the companies, these cyclicals, industrials, materials, energy, could be the leadership of the next bull market. That would be my presumption, unless something meaningfully changes between now and then, unless we get a lot more fiscal support to really expand supply. Then those companies could run earlier. But in the here and now, it seems like most of the fiscal spend is demand construction, not expanding supply like we need it. And demand construction is essentially legislators fighting the Fed. We don't want to see that. It just makes the Fed's job more difficult. And I, for one, actually believe this Fed. I believe that they do intend to fight inflation. I know the market, the bond market, the stock market are all fighting the Fed. The crypto market's joined in now, I'm sure much to the chagrin of Jay Powell and company. And I just don't see an environment where this is going to lead to any good monetary policy outcomes. I think that the more the market fights the Fed, the more the Fed is going to not only stand behind their higher for longer mantra, which has compounding effects over time, but they'll also continue to run off their balance sheet, which also has compounding effects over time. That is to say that the longer that rates are higher, even if they stay flat, the more companies have to refinance at higher costs, the more consumers that have to pay higher bills on their debt. All that revolving debt, those home equity lines of credit and credit cards become more painful. And then anyone who wants to move, who wants to refinance their mortgage or otherwise is going to have trouble. As we saw in the mortgage chart, those mortgage costs have surged. So what does this mean? To me, it means that we're entering a different paradigm, one where the old economy may once again lead. Speaking of tech, the NASDAQ is extremely overbought, and this time isn't like the last time. The last time happened after the COVID crash, and you can see leading up to the extremely overbought condition we had back then, we had an extremely oversold condition, negative 103. I think that was the most oversold the NASDAQ had been since the dot-com bust, if not ever. This time, we had a negative 34.61 leading into a positive 86.34. That is not an oversold bounce back correcting itself violently. Instead, this seems to be a bit of euphoria, and I would look at things like Bed Bath & Beyond, GameStop, AMC, Carvana, and other nonsense stocks rallying as evidence of that. That's not the leadership we want to see. Yes, we are seeing some strength in materials and industrials and energy, and that's encouraging, but that's to be expected with the Chinese reopening. That doesn't necessarily portend to a new bull market paradigm, however. It could be part of an extended bear market relief rally, as from a macro and fundamental perspective, nothing has meaningfully changed. And from a technical perspective, we've yet to really make a higher high. We've made a higher low, arguably. We have not made a higher high, so we cannot yet say with any definitive certainty that the downtrend is over. And when you start getting overbought readings like this on NAMO and NYMO, as well as a number of other places, we see retail inflows in stocks surging as well. We see zero DTE, or basically options that have 24 hours or less until they expire. That activity in SPX and single stocks is absolutely surging on the call side. Rare is it that this type of activity leads to a discernible bottom. And if it is a bottom, it will be one of the most expensive valuations for a bottom that we've ever seen, which would mean a short and shallow bull market to come, which I just don't think we're there yet. I think, like prior bear markets, this one is likely to end not just when the Fed pivots, when they meaningfully turn around to aggressive cutting and quantitative easing. I also believe we need to see retail, folks like you and I, sell more of their holdings. Retail exposure as a percentage of their total net worth to equities is near record highs. We also have not seen margin debt fall the same way we have during prior bear market endings, where it goes from peak to trough down over 50%, like it did during the great financial crisis and the dot-com bust. At this point, we're around 40% last reading. There's more to come. And then finally, the amount of activity in the options market, circling back to that, is insane. Because leverage has become more expensive to employ elsewhere, people are employing it through options and in shorter dated options contracts, mostly same day. 44% of S&P index options are traded with an expiration of 24 hours or less. We've never, ever seen anything like that before. And I don't think that story will have a particularly happy ending. If that's what's helping to push prices higher, it's essentially a pocket of hot air. It is a delta squeeze of the most enormous magnitude possible. Q3 bank losses that are unrealized of yet are approaching $750 billion. A lot of it is on held to maturity securities like bonds. But there's a fair amount, about half, that's also on available for sale securities. This to me suggests that there is some trouble within the banking system, particularly because the amount of reserves that they have are similar to what we saw in 2006. That doesn't mean we're coming up on a great financial crisis, so let's not go there. What it does mean is there's cracks building underneath the surface. And it tells me that this is one reason that banks are borrowing at the discount window, because they can take these securities that are arguably marked down considerably and say, look, we don't want to sell these right now, but we need liquidity and we need it now. And that would explain some of the borrowing we begin to see at the discount window during 2022. And of course, we'll be keeping a close eye on that activity. And I'll be reporting back both on TraderAid and to YouTube as I have updates about what's happening at the discount window and within the financial system as a whole. But this does not look great. There's a lot of hope in this chart. The hope that they can hold these held to maturity securities to maturity, and the hope that the available for sale securities will come back in price. Major central banks pumped an inordinate amount of liquidity into the financial system in response to COVID. Similarly, in response to the great financial crisis. But you can see COVID was straight up parabolic. One enormous ramp of liquidity, only to run it off at a faster yearly percentage change than we've seen in decades. This is not a good sign, and it has a lot to do with those unrealized bank losses, by the way, but it also has a bigger effect. Let's take a look at money supply. The growth of money supply is collapsing. In fact, going back to 1983 on this chart, we've never seen money supply contract this quickly in growth. This is dangerous. There's no other way to describe it. It doesn't mean, again, that we're headed to some sort of imminent financial catastrophe, but it does mean that what's happening underneath the surface is that there's less liquidity, there's less money in the financial system, and that is going to begin to matter a lot. How are debts to be paid down? Debts require additional money coming into the financial system to be able to pay down that interest that didn't exist in the money supply, that interest that needs to be paid on that debt. This leads us to the potential of some kind of liquidity crisis, which could eventually create a financial dislocation. And maybe, just maybe, that's what eventually gets that mythical Fed pivot unicorn that everyone seems to be clamoring for. You know, the same folks that say we're headed for a soft landing, which would mean the Fed has no reason to cut anything. Well, we'll just have to see what happens there. But I think that the most likely scenario for the Fed actually pivoting is that they break something really big. I don't think the inflation genie is going to go back into the bottle very easily. And with the persistence of core services inflation showing us that it's continuing to rise, that suggests the same, as does the tightness in the labor market, where there's 1.7 jobs available for every unemployed person seeking work. So I'm going to be keeping a close eye on money supply here too, because this concerns me quite a bit. You can notice peak to trough, this is much worse than what we had going into prior situations where there was stress in the financial system. So again, it doesn't mean there's any imminent collapse, but it does mean that risks are growing meaningfully. And here's one reason why. We can see when we compare Fed liquidity to the pricing of the S&P 500, and granted this chart is a bit old, the pricing of the S&P has risen more and liquidity has fallen more. But it's an important chart to share because it's had a reasonably strong positive correlation with the performance of stocks, and it suggests that those stocks are likely to retreat as liquidity does. So what does that suggest? To me, it suggests that we are likely to make a new lower low this year, probably in the first quarter. Used vehicle prices have fallen the most on record. This is great news for the disinflationistas out there that are looking for signs that we're making progress. And indeed, on the good side, we are. On the services side, not so much when we look at core. But on the good side, this is a good sign, right? But think about what's driving it for a second here. Not only are some of the supply chain constraints in the auto sector beginning to alleviate, and that's good, but also those folks that have more car than they need are selling those cars to raise cash. That's another thing that we can see in this dramatic fall, which again, this is the largest price fall on record. Speaking of dropping fast, existing home sales are falling faster today than they did during the Great Financial Crisis or any other time that is similar to this in history. That's not a great sign. And it speaks to the struggle that both existing homeowners that want to move, as well as people who want to move into existing homes, are dealing with. Prices are too high, rates are too high, the cost of living outside of any of that is too high because the price of food is up. The price of utilities are up. Everything that people have to deal with, property taxes are up because of home prices. It's just become unaffordable. So again, going back to 50% of millennials living with family before COVID. Now it's even worse. Now those same folks don't have that trajectory to get a new home because unfortunately, unless they got really lucky in the market somehow, their purchasing power has been further eroded. Their ability to buy a home is almost non-existent, and they are at peak home ownership age. They are at the age where they need to be buying homes in order to build equity, in order to have a chance of paying down that mortgage, in order to participate in the nonsensical American cycle of buying a new home every 7 years, therefore never really paying down anything but some level of interest on your debt. And if you didn't know, mortgages are constructed such that really for the first 10, 12 years, you're just paying interest. You're not even paying principal. So with the average American moving every 7 years, you can see where the math goes. People basically only get equity by the appreciation of home prices, not by paying down the debt that their mortgage implies. So with Millennials having this kind of struggle, it suggests that a very big contingent of consumers are not consuming commensurate with prior trends. That's not a great sign for an economy that, again, is 2/3 driven by consumption, and when real estate is 15 to 18% of total GDP. And the last chart I want to share, and I'm going to rant about this a little bit, because I keep seeing this stuff and it's utter nonsense. There is no chart analog that will predict the future. The folks that are peddling this stuff are doing it for likes, they're doing it for engagement, they're not doing it to help anyone. They know very well that their charts have no predictive capability. Comparing the present to the past and assuming that the market is going to do something similar that it did in 1962 or 2008 or 2015 or 1973, it doesn't make any sense at all. And you can find analogs for bulls and bears, as this quadrant of charts suggests. There's always something. There's always something to hang your hat on and say, well, what if it's like this? Let me tell you something right now. It's not. Just put all this stuff away. It doesn't do us any favors. It's great clickbait. It's entertaining. You can laugh at it because it makes no sense at all. All the drivers are different. The market is entirely different. Valuations are different. The macro picture is different. The fundamental picture is different. The technical picture is indeed different as well. So, my humble request, put this stuff away. If you're posting it, please stop. If you're liking and retweeting it, please stop. It's not helping anyone. People that look at this stuff and think that, oh, because this happened in 2008, it's going to happen again. It's not. It's not the same at all. In 2008, we had an enormous dislocation because of an incredible financial catastrophe. That's not really what it looks like. It doesn't look like we're just going to careen off a cliff here. Now, of course, I could be wrong, but it doesn't mean the charts are going to look the same. And for the bulls, I mean, none of this stuff makes any sense either. There's no comparison between 2015 and now. In 2015, we were still getting quantitative easing, artificially low rates. There was still room for valuations to get stretched. These analogs are worthless. So my humble request is just put them down. Let them go. They have no practical value whatsoever. Thank you everyone for tuning into this video. If you'd like to become a member of TraderAid, I've got a special 20% discount just for you. Use the code Mayhem20, my namesake, Mayhem20 at checkout. Get 20% off your monthly or yearly plan on me. Thank you again for tuning in, and I'll catch you next time.